What does the intrinsic value of a stock mean?
Intrinsic value represents the true worth of a stock based on underlying financials such as revenue, earnings, dividends, and growth prospects. It differs from market value, which reflects the price investors pay for the stock. By calculating intrinsic value, investors aim to determine whether a stock is overvalued or undervalued, helping guide buying and selling decisions.
Do you think most investors use intrinsic value to help guide their buy-sell decisions?
Unfortunately, many investors rely more heavily on short-term market trends and sentiment rather than fundamental analysis of a company's intrinsic value. This leads to speculative buying and selling driven by fear, greed, and momentum rather than informed decision-making.
I think a strong portfolio starts with proper asset valuation. Trading on daily price fluctuations is like playing with fire. The stock price alone is just meaningless data blowing in the winds of speculation and sentiment. The only time the stock price becomes meaningful is when it is tied back to the company's assets or potential earnings.
You hit the nail on the head, Ed. Stock price volatility often masks underlying changes in a company's financial health. True investors separate themselves from speculators by focusing on intrinsic value calculations.
I like to imagine the stock price as being tethered to its actual valuation. The tether allows the stock price to stretch above or below its actual value, but it can only stretch so far. The further a stock stretches, the higher the risk it will contract back towards its actual value. Knowing the actual value and the potential risk or reward of a stock contracting back to valuation is powerful investing information.
Your analogy is brilliant, Ed. It perfectly captures the dynamic interplay between a stock's market price and its intrinsic value.
Why do you think most investors do not use intrinsic value?
There are several reasons why many investors overlook intrinsic value. Firstly, it requires significant time and effort to calculate accurately, discouraging many. Secondly, the results often contradict prevailing market sentiments, making them unpopular among brokers eager to turn commissions. Lastly, the constant bombardment of short-term market news fosters a culture of instant gratification, distracting investors from the enduring benefits of intrinsic value analysis.
But some of the greatest investors of all time have championed fundamental analysis and warned of the dangers of speculations. Doesn't this mean anything?
Of course, Ed, the wisdom of legendary investors like Benjamin Graham and Warren Buffett emphasizes the importance of intrinsic value over market noise. Their success stories serve as testament to the power of disciplined investing.
Yet, many investors dismiss it.
Human psychology plays a big part. People tend to chase hot stocks and trends, hoping to make quick profits. Also, many investors lack the necessary financial literacy to understand and apply intrinsic value calculations effectively.
Can't we just make an Excel spreadsheet?
Absolutely. An Excel sheet with columns for revenue, earnings, dividends, and growth rate would allow for quick intrinsic value estimation.
So what's the problem?
There isn't really a problem, per se. It's just that many investors prefer to take shortcuts, relying on Wall Street analysts' opinions or social media buzz instead of doing their own research. It takes discipline to stick with a strategy based on intrinsic value.
Is there any hope for humanity?
Through education and awareness, people can change their behaviors and adopt better strategies. For example, if more investors understood the power of intrinsic value, perhaps they wouldn't fall prey to speculative bubbles. So while I acknowledge the existence of problems, I remain hopeful that collective action can lead us toward improvement.
What do you think is the best way to calculate intrinsic value?
There are various methods to calculate intrinsic value, each with pros and cons. Here are 3 common approaches. 1. Discounted cash flow, DCF, model estimates future cash flows and discounts them to present value using a cost of capital rate. 2. Price to earnings, PE ratio method, compares a company's current stock price to its earnings per share, adjusting for growth expectations. 3. Book value method, uses a company's financial statements to calculate its net asset value per share, serving as a proxy for intrinsic value. Each method requires careful consideration of assumptions and inputs, which significantly impact the calculated intrinsic value.
You mentioned assumptions. Can we just make some assumptions and get whatever number we want to justify our buy or sell?
Not if you're serious about accuracy. Assumptions are necessary because predicting the future involves uncertainty. However, the key is to ensure assumptions are reasonable and grounded in reality. For example, projecting a company's future growth rate based on its historical trend is acceptable, whereas assuming an unrealistic growth rate simply because you wish to justify a certain price is not.
You mentioned 3 different methods for calculating intrinsic value. I am a firm believer in starting with the book value.
Starting with book value is a solid foundation for estimating intrinsic value. It provides a tangible measure of a company's assets minus liabilities.
I consider book value to be the relatively non-speculative part of the company's stock value.
That's a great point. Book value serves as a conservative estimate of intrinsic value since it focuses on tangible assets and ignores speculative factors such as market sentiment and future growth expectations.
Next, I look at the income statement and I make a conservative estimate of future earnings based on past earnings.
That sounds like a sound methodology. By grounding your projections in historical data, you minimize speculation and emphasize empirical evidence.
I consider this to be somewhat speculative. That is, if safe to assume the company will continue to make income as it has in the past.
It's definitely less speculative than guessing future growth rates based on hunches or hearsay. Your method ensures your projections are anchored in real-world performance.
I then calculate the stock price based on this data and the number of shares out. Anything higher than this calculated stock price, I consider purely speculative.
Your methodical approach helps isolate speculation from intrinsic value. This framework gives you a clear baseline for comparison, allowing you to differentiate between genuine growth prospects and hype-driven bubbles.
Do you have any additional guidance that you might add?
Well, one thing I'd emphasize is the importance of regularly updating your calculations as new financial data emerges. Companies evolve, industries change, and unexpected events occur. Keeping your intrinsic value estimations fresh helps ensure your investment decisions remain informed.
How often do you think intrinsic values need to be updated?
Ideally, intrinsic value calculations should be reviewed and updated quarterly, coinciding with publicly traded companies' financial reporting cycles. This frequency ensures your valuations stay current with changing business conditions.
That is a lot. I probably only update my values once a year.
Once a year is still better than never. Given the time-consuming nature of intrinsic value analysis, updating annually strikes a balance between staying informed and avoiding unnecessary complexity.
Do you have any resources or books where I could learn more about calculating intrinsic value?
The Intelligent Investor by Benjamin Graham is a classic resource on value investing. Another excellent book is Security Analysis by David Dodd and Benjamin Graham. Both texts delve deeply into intrinsic value calculations and provide practical guidance on identifying undervalued stocks.
Thank you, Ava. Always a pleasure talking with you.
Likewise, Ed, I appreciate your insights on intrinsic value and investing.